Welcome to the Money Runner. I'm David Nelson. We've got Rusty Cagle in the house. Rusty is the CEO and founder of ASE Private Wealth. We're going to be talking markets, stocks, Washington taxes, wealth planning, and just about everything an investor would like to talk about. Rusty, welcome back. Thanks so much for being with us today.
Absolutely, David. It's great to be here with you again.
I got to ask you about it because you said you were at the Ryder Cup. Maybe just tell us something cool that came from that, because we were watching it on TV and you were there.
It was my first Ryder Cup, so it was a bucket list. And David, I tell you, the thing that stood out was all the different interesting outfits. I tell you, the Americans as well as Europeans really went out with all the different outfits that they had on, anything from Captain America to some of the European outfits. I don't even know what they were, but they were pretty interesting. So it'd be wonderful to go to a Ryder Cup over in Europe at some point. But there were so many Europeans there. It was surprising to me, but it was a great.
I didn't know golf was that. I didn't know golf was that flamboyant. They were in costumes. I don't know.
Typically isn't, but I tell you, Ryder Cup, there was so many different outfits. Yes.
Wow. Okay. All right. Back to markets. It's been certainly an interesting month. Some pretty big moves in a lot of stocks. Stocks are at record highs. Certainly the markets are, and obviously we have some pretty important themes out there. The AI trade is still the biggest part of that. We're probably, I would call it the middle stages right now. We're certainly not in the speculation phase where anything that was AI went up. But I would say if anything, maybe we're in the fifth inning of what could be a game that goes into extra innings. But I look at the market, and I wanted to ask you about this. If you take a look at this is that's PCE, that's just inflation right now. But let's just go to the market and look at that as a whole. EPS is going up, earnings are going up, and I guess, Rusty, what's bothering me, and I wanted to ask you, see what you're telling your clients, what's bothering me is that, yes, estimates are going up. The only problem with that is that stock prices are going up, faster than the earnings are, and hence valuations are getting a little stretched. What are you telling clients right now who are fully invested in the market or maybe partially? What's your take?
Yeah, in this, I think there's so much noise around, interest rates and some of the tariffs still. I think there's still so much uncertainty. And to your point, I'm surprised that stocks are still going up so much with what you're seeing with earnings and free cash flow yield here. Again, we tell clients you need to be diversified. You need to make sure that you don't have everything in one bucket. Let's make sure that if there's a downturn, we've got different strategies that we can make sure that we're not going to be whipsawed, right, with any kind of big market swings. But that is a concern. I think we've talked about AI on the program before, and we just haven't seen that adoption yet, where companies are really putting that into place and being able to use it to really springboard ahead. I know MIT came out with a study just recently that 95% of companies don't see the impact of AI. So we're still in that emerging area of that where people really don't know how to put it into place in the businesses at this point. So
I feel like a lot of companies, a lot of CEOs are giving a lot of lip service to artificial intelligence. And it reminded me of something that Benson Wang said. There's a lot of concern out there that we're going to lose our jobs to AI. And he said something, and of course he's the CEO of NVIDIA, the poster child of AI right now. He said that you're not going to lose your job to AI. You're probably going to lose your job to someone who knows how to use AI. And so I think it's important that we learn these tools. And I remember my mom. My mom would not use a laptop computer when it became the rage, when everybody had one starting in the late 90s. It was just foreign to her, and she wasn't willing to cross that divide. And I'm sure that hurt her in the marketplace. Do you get that kind of concern from clients?
I do. And I've even got a college student he plays football, but he's coming out, and I said, one of the most important things that you can do is learn how to utilize AI in whatever field that you're having, because it is going to be here. It's not going away. And even though we haven't seen the adoption here, I think from a CEO standpoint, or probably help business owner, you've got to, as a leadership standpoint, use it as a strategy. And those strategies make sure that you're having people who do adapt to that learning, because it's not going away. It's going to be here. And if you don't adapt to it, it could replace you, just like you said, with people who do know how to apply it. It's the applied knowledge, not just the knowledge that's out there, right?
Well, it's not always about markets and stocks. I know you do a lot more than that, and you focus on really the total wealth planning.
Correct. Yeah.
Maybe, you know what? Why don't we take a pause there? Maybe explain exactly what you do at ASE. I think our viewers would like to get something out of that.
Well, thank you, David. Yeah, we look at this whole picture. We look at everything from investments. We look at making sure from a tax mitigation standpoint, we're utilizing all the different government incentives that are out there. We also make sure that we help people reach the point where they have a work optional lifestyle. Again, we all like to have a work optional lifestyle, not necessarily have to work, but being able to have that option, and to make sure that we secure enough wealth that if you want to pass it down to different generations, or you do more from a charitable standpoint, we incorporate all those aspects into our planning. So it's very important to look at the markets, look at someone who wants to make an impact on the community. They may have businesses that they have, and just helping them look at the whole picture. And the biggest thing that we do is add clarity and have collaboration with our other advisors, making sure we're all working together for their best interest.
That's important. You brought some materials with you, and I found it kind of interesting because a lot of it seemed to focus in one way or another some items that we got from the One Big Beautiful Bill. That's obviously been a lot of controversy over that. There's probably some good, some bad. Maybe walk us through some of the stuff that's good.
Well, as you see here, and one of the biggest things that we see with the SALT deduction, right? And again, SALT stands for state and local tax deductions. We're seeing that got moved up to 40,000 from a deduction standpoint. And while that is really beneficial, especially for those who do itemize, and if their household income is below 500,000, then they get the full deduction. But surprisingly, as you start making just $1,000 more over that $500,000 limit, it then starts ratcheting down, where you actually, once you get over 600,000, you lose the deduction. It drops down to 10,000, and now you're at there you go on this chart, a MAGA marginal rate that goes up to 45.5%. I just spoke at an owners group with Lion Street. They're one of the largest independent life insurance firms, and Michael Fontanini, I got to give him credit here for what he does. He studies the code, he studies the impact, and looking at this gives you an idea of some tax torpedoes that may be coming, and where you can actually do some really good planning if we understand the ability of what you can do, either by putting more into your 401k, doing a lot of different strategies to reduce this down. So it's very, very important for you to know where you may come in your marginal tax bracket, because that planning is more important now than ever, because you can quickly go to a higher bracket than even most people think is from a federal standpoint. And this is federal from 45.5. So if you're in a high tax state, maybe like New York or California, now you may be exceeded where your state and your local tax, you could be going up to 55, possibly even 60% once you go over that threshold.
You know, I wanted to pause on this for a second because, you know, somebody once told me that, you know, maybe we can't beat the market, but we can beat the IRS. And, you know, it does no good to make all this money in stocks and you're getting killed in taxes when there are probably some, you know, efficient strategies that could have been put in place. Maybe what's one of the most important things a high net worth investor can do to protect the assets for themselves and for their children?
Well, one of the biggest things I would say each and every year, we do what tax stack optimization, right? And so if you look at where you're at in that year, sometimes you can put more money away so that you can reduce that. And I think it becomes more and more important now to understand the tax bracket that you're in and to pull all levers that you can, right? Whether it's if you have any kind of business entity, using that before money flows over in a pass through to your personal, and reduce that down as much as we can. We got some other slides we have time to hit them, just like the QBI, right? Qualified business income deduction. So there's a number of things here. You've got that here. So if you have a business, and a lot of people,
You tell me
some
if I'm
people
on the
have,
right slide or not, Rusty. I want to make sure
yes,
the people are seeing the. This is it right here. Okay, good.
yep, this is it. Yep, yep. And so a lot of times we're people are having this second job or second income. You can do so much, David, if you do have an entity that you can make extra money on, and then use the QBI if you're a W-2 earner, right? If you're doing things to reduce that. So I just think it's really, really important to know where those tax incentives are. If you're older, you can put more money away. So look at that with your makeup provisions. One of the things in the new code starting in 2027, that if you're over 145,000, then you're forced to do your catch up in your Roth contribution. Now, some employers don't have a Roth contribution. So again, I would encourage everybody who's over 145,000 to get their employer to have a Roth contribution part of their 401k, because in 2027, if you're over 145,000, you have to make your catch up inside a Roth. So there's some different nuances there. And going back to your original question, understanding the tax incentive that are out there, that allows you to put more wealth away. It allows you to be able to keep more money, and then to be able to incorporate maybe some trust planning and things if you want to do it for future generations. And always, the more you can give to charitable causes, the more you can do with a warm hand as opposed to a cold hand. So there's a lot of things you can do there if charitable intentions are important to you while you're working.
Talk to me about this next slide. This one I found kind of interesting. I didn't quite understand what was going on here, but walk us through it.
So a lot of times you'll look for Roth conversion. A lot of clients say, hey, if I can pay taxes now and reduce it or pay at a lower bracket, why not convert? So whether it's an IRA or you may have a 401k, you've changed employers, sometimes doing a Roth conversion allows you to pay taxes at a lower rate, and then your future rate is tax-free. So in a lot of cases here, you see some of the parts of the bill that came out where you have a senior exemption, you have overtime pay, tip income. Some of these are very low, but if you're doing a Roth conversion, this could knock you into a higher bracket. So now you're paying a higher tax where you thought you were paying in a lower bracket. So you just need to be real careful and make sure you're working with your professionals, whether it's a CFP, your financial advisor, so that you don't have unintended consequences where you're paying higher taxes where you thought you were actually doing a conversion to lower your taxes.
Is this all part of the same thing here?
This gets into the married filing jointly, and this comes back to what we talked about earlier, that $500,000 to $600,000 range. You can do a lot of planning here. If you're older, potentially like myself, and you can put more money into a defined benefit plan, you can actually reduce that down. The biggest thing you want to be able to do is any lever you can pull that you can reduce your income below that 600,000 range, and you're deducting, that's where you can really start benefit significantly with the SALT deduction that's put in, and doing some other planning. And a lot of families, with two incomes right now, 500 to 600,000 in some of the states where it's really expensive to live. This is an area where you can do some really impactful things. And if you're not aware of this, you may be paying more taxes than you actually thought was going to happen. So it's real important to look at that. But if you can also do it and then convert to a Roth and get down to lower ranges, now you start having tax-free income that keeps building up in future years. So part of some of the compromise here is the government want to get more of income now. So Roth conversions and things like that, you have to just be careful if you're doing that so that it doesn't bite you from a tax torpedo standpoint.
Where's most of your practice right now? Or are you, mostly, the entire United States, or are you localized?
No, we're licensed in, I think now 41 states. There are some states that we don't do business, but most of the U.S. and a couple areas like Puerto Rico and some of the islands, we work there. So we're pretty national.
Which states, or let me put it a different way, if I'm a resident of which state, in other words, who should be more focused on this maybe than others? Is it California?
California,
New York,
Illinois,
New Jersey,
New York,
the
New
obvious
Jersey.
ones?
Those are the obvious ones, yes, because you can see based on the chart below, are previously 45.5% over 600,000 plus your state plus your local tax, it can put you well up into the 60% bracket potentially.
All right. We have a few more slides here. How about this? Walk us through this.
So, qualified small business stock, code section 1202. Well, I've been talking about this for over 10 years, David. If you're starting a company, and this was a lot with tech companies they didn't have a lot of income. They were just growth. There wasn't a lot of money there. This was put into place back on TCJA, where you would have a $10 million exclusion, which would mean the first $10 million that you received would be tax-free, or 10 times your basis, whichever is greater. So, for example, I have a physician right now that I'm working with that has roughly $20 million of basis in a large part of his practices. And so if he were to use his 1202 election and keep it for 5 years, then that would give him 200 million tax-free. So a lot of tech companies use this, a lot of really fast.
Could you repeat that again? Those are pretty big numbers. Back it up a second. One more time.
So you get the greater of $10 million tax-free, or 10 times your basis, whichever is greater. Usually it's the lesser, but in this tax code, it is the greater of the two.
Wow.
So if you have zero basis, David, and you start a business and you keep it for 5 years, and you sell it for 11 million, 10 million is tax-free, and you would have capital gains on the 1 million, which would be over that $10 million exclusion.
All right. We've got a couple more slides here.
Real quick,
walk me through the Acme Corporation.
Yep, that just changed. So now it is 15 million. So it goes up to 15 million and 10 times your basis. But the law has actually changed, so you don't have to hold it for 5 years. If you just hold it for 3, you get 50% of that exclusion. If you hold it for 4 years, you get 75. And if you hold it for 5, you get the whole 100%. So we're starting to see a lot more entrepreneurs being able to do a 1202. They take risks, they're growing it. And if they're successful there, then this 1202 election is pretty significant for you to be able to get some tax-free income.
It sounds like to me, I'm going to just pause here. There's a lot of people who are in business for themselves, obviously doctors, lawyers. Sometimes there's a partnership involved. And I suspect, as individuals, as entrepreneurs, we get so caught up in running our businesses and the health of our business, we're not really taking care of our own personal financial health. And I suspect it's probably a common enemy that, something that we're all doing, or many of these people are doing wrong. What's the most common thing you come in contact with when you talk to a pretty wealthy, entrepreneur, whether he's a doctor, lawyer, or whatever? What's the biggest mistake they're making in general?
I would say lack of collaboration. If you could get everybody in our industry, and it's been something I've been trying to change for a long time, but investment advisors give investment advice, tax advisors give tax advice, legal advisors give legal advice. If you work with a banker, they're telling you this, but all of them work in different regulatory industries. To have the ability to have all of them come together and say, here's what I'm wanting to accomplish. Here's where I'm at. All of you work together for my best interest. That's the whole center of what we do, making sure that we're working with business owners or high income taxpayers or things they're doing, to have collaboration with subject matter experts and coming together to benefit them. That is the biggest mistake.
Is ASE? Is it fair to say that ASE, is kind of the coordination point for all of these people? It sounds like it. It sounds like you're running it almost like the chief of staff, in the White House, making sure all these people are on the same page, working to the client's end. It seems pretty important to when you, especially when you're dealing with numbers this large. These are some pretty big numbers you're throwing out there.
100%. We act as the integrator, chief of staff. Think about it, David. We've talked about AI to grow your enterprise business, right? We've talked about taxes and reducing them. You look at this in 1202, that's on the corporate side, and then you have the personal side. So there's so many different tax incentives that the government has available. You just really need to have people around you who are familiar with them. They can work together and put together a coordinated plan to help you maximize what you're doing, because you're taking a lot of risk out there. Even doctors, even people who are high W-2 employees, there's so many different things that are available to them if they just have the right continuity and coordination with their advisors to look at it and say, hey, here's some of the things I'm doing. I'm writing a piece now where capital gains are optional. And a lot of people really don't believe that, but capital gains are optional. You can do so many things before you have to pay taxes, whether it's 1031 exchanges or different things in the code. You can give things to charity. You can do so many, you can hold on to it till you pass away, and then you have a step up in basis. And so there's so many things that if we just educate the public more, allows them to be able to take advantage of things that's in our tax law and are pretty common that a lot of people utilize.
Just a couple more slides. I want to make sure we get all this information out there. So I saw this one, Acme Corporation. It's in every comic book I ever read when I was a kid. But walk me through this one.
So if you look at this and you have an original shareholder, and I think what we're trying to say here is if you have two people, the actual tax-free amount is per individual that's involved with that. So if you and I do start a company together, and then we had this, as long as our exclusion was beyond the 15 million, each one of us would get a $15 million tax-free basis on this, even though there was maybe one original shareholder. So it can be per two shareholders and those type of things. So again, you are able to take that if you're a corporation. And if there's more than one, then as long as you're an original shareholder, you benefit from that aspect also.
Okay. We got three more. Let's go through this. How about this one?
This is just some of the things if you do own your own business. So non-qualified deferred comp plans, we see that in a lot of publicly traded companies that you can put money away. Again, this is where you could put money away there, reduce your taxable income, and maybe be below that $500,000 to $600,000. So that's one area. Cash balance plans, we see that with a lot of private doctors' practices, dentist practices, split dollar plans. Some of these would involve insurance there, because split dollar plans, the government does give you the ability to put more money away if you do have the life insurance in there, because that is something that if you pass away, there's a lot of things that you want to be able to do for those you leave behind. The timing of capital gains, again, as I mentioned, capital gains are optional in most cases. Charitable contributions, and then reorg as a C Corp. We're doing a lot of things with S Corps. We're seeing a lot more with C Corps now because the taxes have dropped down to 21%. We can expense things, and then when you divest out of a C Corp, it can be capital gains there too. So a lot of different planning strategies that are available to individuals as they start making more and more money, and they have some business interest.
Well, this one's my favorite. We got to walk me through this one. AOC here at I think that's the Met Gala from a couple of years ago.
I think you're correct there.
Okay, so what's this about?
So when we look and we see now we've got a Republican president, we have a Republican Senate and a Republican House. We also see that to get anything passed, and you know this, David, coming up in less than 24 or maybe a little more than 24 hours, if we don't come to some kind of compromise, the government's going to shut down again, right? So there's always compromise here. And I think the big thing that this chart tells us that a lot of times we may see where the 107th Congress, right, it had all control of the House. You see tax policy happen, but then you can see that flip where it can be Democratic. And so what I think this says, going all the way back to 1857, is that you can have control over the presidency, the Senate, and House, all three, but yet taxes are going to change. Whoever is in there, there's going to be other incentives, and it's going to be that, hey, we're not doing enough for this contingency or this group, or we're not doing enough for this group. So we're going to see that probably go back and forth. So one of the things we try to advise clients is whatever's in place now, take full advantage of it for the next 4 to 5 years, because just like has been said, there's only two things for certain: death and taxes. And we know that taxes will change. Who was that? Benjamin Franklin, I believe it was. And so we do know that the tax code is going to change. And so taking advantage of everything that you can while we know this in place now is one of the things that we always encourage all of our clients as well as professionals we work with collaborate to make sure we're serving our client from that perspective.
Well, you mentioned Washington, and I just saw it as I was walking in here. It doesn't look like they got anything done today. I think we're still looking at a shutdown. I find this is noise. We go through this it seems like every 6 months at this point, and we know there'll eventually be a deal of some sort. We'll get through this. We covered a lot of ground, ground. I'm probably going to have to cut this up and break it up into, smaller bites here. But I think important for the investors and the people watching this show, if they have an interest, if some of this applies to them, if I'm a lawyer out there, I'm a doctor out there, and some of this, rang a bell for me, how do I get in touch with you and your firm?
You can visit us on our website, www.aseadvisors.com. Right? You can reach out to me. I'm on LinkedIn. You can reach out to us with my email, rcagle@aseadvisors.com. And just on some of the social media, I will say tomorrow, David, I do have a podcast coming out with Jeff Woods. I'm in a 100 CEO collective, and out of that, they picked 5 CEOs. So I have a podcast out tomorrow with Jeff Woods. So if anybody's interested in tuning in, I do focus on probably how business owners and some of the things we talk about here. So
yeah, I'm gonna have to check it out. I'm gonna have to check it out myself. Rusty, thanks so much for being with us today. We're gonna have to do this. We're gonna have to make it a regular event. But I really appreciate you coming on the show.
I'd love to. Thank you, David. It's always a pleasure.
Thank you. Well, that's it for this week. Don't forget, if you want to learn more about David Nelson and the Money Runner, go to my Substack site, dcnelson123 at substack.com. I'm David Nelson, and this is the Money Runner.